This is Rod Kusin, Spooman with Risk, here to demonstrate our new automated Fibonacci retracement and extension tool. As this is a teaching video, our purpose will be to go into more than the usual amount of detail to show our users how it works and how they can set this up to run in an automated fashion. Let's first, however, talk about the use of the manual TradeStation tool. Now here we have a 1000 tick bar chart, and if we were going to draw retracements, typically what a trader is going to do is he's just going to eyeball the data on his screen and will somewhat arbitrarily elect certain pivot points on which to draw his retracements. Now let's take a look at this as an example. Now we can obviously see that there's a pivot point here on the screen. There's a pivot point way up here. But did you fail to notice that there's one here? Now there's one here as well. So now depending upon where you are in the stream of time is going to also have some impact on how you decide to draw your lines. The point of the matter is, to be objective about the procedure, we need to have a definition, a way to quantify where our pivots are. The TradeStation tool known as the high and low pivot show me study is one way that we can do that. High pivots are here defined based upon a left and a right strength from what is considered to be a pivot bar. Left strength means that from the left of the bar in question, we have no higher pivot. 10 bars to the right means that to the right of that bar, we also have no higher pivot. If we use the same definition for our low pivots, we now have an objective way to define where our pivot points are. Now, by the way, I did not mean to imply that we need to use the same left and right strength for our low pivot as our high, but that seems to make some measure of sense. So now, for example, if we use this definition, our low and high pivots are now drawn on the screen. So in between this original point A, if you will, to point B here, there were no other pivots. And consequently, an objective retracement could be drawn between these two levels. But now if we were going to go from this point A to this point B, we see that there's already been numerous other pivot points in between. So from an objective standpoint, it really wouldn't be fair for us to ignore all of these pivots, because in real time you don't know exactly where these pivots are going to appear. You don't know, for example, that this isn't your high. You won't know that until after the fact. Neither will you know that that's your high. And you really won't even know that this is either. So, depending upon how you're defining your pivots, you're going to get different results. In any case, it's important to use an objective method for making those definitions. We'll show you why that's important even more so in just a few minutes. So step one is to define your pivots. Step two is to draw your lines. Now, using the manual tool that comes with TradeStation, let's get that right. We're going to use this as point B. So from a standpoint of a retracement, we'll draw the line from this point back down here. And now we have whatever number of Fibonacci lines that you have selected. The difficulty in just this procedure alone is that the typical trader will once again eyeball the retracement just for the sake of expediency. When you use an eyeball approach to where your pivots actually are, you're not going to be accurate. And if you don't want to be accurate, then why bother? So really, the procedure to be done correctly is know exactly what the high is of your point B here, 1238.75, and know exactly where your low is, 1227.25. To do that, you'd have to go into the tool, and eventually when it comes up, you go over here and you define those numbers. Now once you're done, now you've got your lines. This process takes time. From an automated standpoint, you don't want to waste time going through that process when the market is moving fairly quickly. For example, this pivot right here, let's expand this out just a bit. Now, you don't know that this is a pivot until after at least 1 or 2 bars. And by the time you go around the process of not only defining your pivots, but knowing exactly where your retracements are, that low may have come and gone. So to have an automated tool to do this can be very useful. Our tool does just that. The tool is called the RSK ESJ indicator. It is a very versatile tool that does a number of different things, including the automating of the process of drawing these retracement lines as well as extensions. To use this tool for the purpose of retracements, we'll come in here and we will define our left and right strength for point A as well as point B. Now, in the definition of our pivots using the pivot high and low show me study with TradeStation, point A is going to use the same left and right strength as we were plotting on the screen. But now, in the case of point B, where we had a high pivot in this case, we can't wait 10 bars to know whether that's a pivot. We need to reduce that to a number that would enable us, hopefully, to recognize where the retracement was in time to take the trade. So we're going to reduce this this right strength to just 2 bars. Our next step is then to simply define our Fibonacci retracement points, and this will be at the discretion of the trader. Now, for example, he may use these 4 that we have shown here, or he could add an additional one, 23.6, 38.2, 61.8, and so on down the line. He can use up to 7. Under ordinary circumstances, using 7 Fibonacci retracements will take you into a retracement that is greater than 100%. So you have that flexibility. We tell the indicator in this field to draw those retracement lines, and the tool has the capability of keeping track of any retracements that are happening above a point A or below a point A. In other words, we could have retracements up or down, or both. So if you're looking for a rallying market to retrace and you don't want to see any retracement that may be coming from the move down, you can eliminate those lines by setting the color of the Fibonacci lines to equal your background color. So in this case, we've set this to black, and we're going to look for our retracements going down. In real time then, this indicator will identify automatically where the pivots are based on the definition, take the exact highs and lows, and then draw the lines without the touch of a button. From a historical standpoint, we can also draw our lines. In order to draw these lines historically, we need to turn on the analysis commentary. When you turn on an analysis commentary, a small box will pop up. You don't need this box, but you don't want to turn it off. So just move it down so that it's basically out of sight. The next step is to simply click on the bar roughly 2 bars after where you wanted the pivot, where you thought the pivot was taking place. So if for example, we click right here, let's get that. All right, there we have it. We're now drawing a retracement between this point A and this point B. And it's just that simple. Now as we move forward, if we find another point A as well as another point B, we'll run a retracement again. Pardon me. Presuming that the point B here is higher, okay? If we have a higher point B, then we'll be running a retracement. So no retracements are taking place here. So as we move forward now, once we get a higher A, now we'll draw a retracement. But you'll notice where the point, I think I said point A here, I meant point B. A higher point B, once that's found, we'll have a retracement. But the question is, where's the point A? You'll notice that it's back at 1227.25, right here. So once again, let's get that right. Once again, this point A was found, and as we used this point A and retained it as we moved up. This is point A, this is point B. We hold on to that point A as we're moving up. And that's how the retracement, the automated retracement lines are being drawn. Okay? All right, very well. Now we said that we have the ability to automate the drawing of both retracements down as well as retracements up. So from point A here to point B up here, we do have a retracement down. But now once we've moved from here down to here, or perhaps even here, we also have a potential retracement back up. So here again, depending on what it is you want to do with the tool, you can either turn off the retracements in one direction or turn them both on. So if we wanted the retracement up, but no retracement down, we just go like that. And we click on the bar, and there we have our retracements. Now, we could potentially have both of those showing up at the same time. This will get a little busy, but it can be helpful. So now you've got both, pardon me, now you've got both of these retracement lines working at the same time. And maybe you don't know exactly how this is going to turn out. But there's a few things that are somewhat interesting about the retracements that are being drawn here. You'll notice that whether we're drawing them up or whether we're drawing them down, we have two intersecting lines at the 23.6% level. So that becomes a fairly likely place where there's going to be some activity. And you see this was tested several times before finally it broke down. So knowing where both sets of lines are at the same time can also be a useful procedure. So now let's review. Two procedures have to be performed to draw a manual Fibonacci retracement. Number one, you have to define your pivots. Number two, you have to draw your lines. But you also have to know the exact position or the exact price of your pivots in order to draw it accurately. Our tool performs both of those functions automatically based upon the definition that the user chooses to place within the indicator, namely the left and the right strength. So in a case where we've got an obvious high and the market is moving down, we need to have some way of defining where our pivots are. We could turn on the TradeStation pivot tool based on the definitions that we've elected to use. These will automatically be placed on the screen once the definitions are met. However, they are not necessary to be shown on the screen in order for our tool to work. All you need to know is what your definitions are. So even if these pivots do not exist, our tool will still work. All you have to do is go into the tool, define your left and your right strength for point A as well as point B. Tell the tool which lines you want to have drawn, and then turn it on. If you also wish to eliminate one direction on the retracement, just set the color to the background color. So now when drawing the tool, drawing the retracements in real time, This will be done without the push of a button. If you're looking at drawing them historically, you need to turn on the analysis commentary. Then simply select whatever bar you wish to draw the retracements from. Just click on that bar and the retracements will be drawn. Okay? And once again, we can also draw in both directions. Let's now take this a step further. When drawing retracements, one of the difficulties is, of course, knowing which, if any, of the retracement lines are going to be hit. While trend is going to have a lot to do with where the market actually retraces to, is there any other objective indicator that we can use to give us at least some idea as to where those retracement lines are most probable? And the answer is yes. As the market plummeted from way up here at around 1255 down to around 1220, that would call for a fairly significant retracement in the event that the market were not to continue to move down, but in fact started to trend back up. One thing that we use that has a very high probability of being hit is our gap indicator. Now, it's a very simple indicator, in fact, and whenever you place this indicator on a chart, it will instantly find any gaps on that chart. Let's take a look. The chart that we're going to reference is referred to here as the 50 share bar. We find that gaps are most frequently recognized on an interval of this size, 50 share bars. Now we know that's very, very fast, but that's where we notice where the greatest number of gaps can occur. Now many people ask, well, now what really do you mean by a gap? Well, before we go on, let's define that. Now we use the 50 share bar to identify our gaps because when you begin to think about the electronic market, there is a fair consistency that the open of the current bar is going to be equal to the close of the previous bar. That just stands to reason in an electronic market that has the highest volume of all of the futures. So if we have an open of the current bar that does not equal the close of the previous bar, we have a gap. And that's what you see here. Here you'll notice that the close of this bar was at the high of 1229.25. The next bar, just one brief bar, was the same. The high was at 1229. There was no activity on that bar. But the next bar opens not at 1229.25, but at 1229. It is one tick less than the previous bar. That's a gap. Look throughout all of your data and you will find that it is relatively rare to find a gap, but sometimes it occurs. And even on bars of much larger amplitude. When these gaps occur, we immediately identify them and begin to track where that gap is at. So here on 12/12/2011 at 10:25 a.m. Central Time, that gap formed. So here's where that gap is, and the market continued to move down before it began to finally rally back up. So you already know from a simple calculation of retracement that your nearest Fibonacci line is at 12/28/25. But you also know that right in that same proximity there exists a gap. So given that retracement, we should now be able to look at taking a long trade, since there's plenty of room to make a profit here. We look for an opportunity to go ahead with the trend, and we have a fairly good target for at least our first retracement, because we know where that gap occurs. Once again, that gap is at 12/29/25. The Fibonacci is at 12/28/25. So a full point higher than that is where our gap will be filled. Now, does that necessarily mean that the market's going to stop on a dime and turn in the opposite direction? Not necessarily. But from the standpoint of having a profit target, a high probability profit target, this is one way it can be done. When our gaps are filled, the line will cease to be drawn. And that doesn't take place until late in the afternoon on that day. And here it lines up right in here. And just shortly thereafter, we have a little bit of a move back down, and the market closes right around where that gap occurred. Now, that's not in and of itself predictive, other than the fact that the gaps, I find, are always filled. Not some of the time, they're always filled. We don't know when they'll be filled, but the probability is very, very high that they will in fact be filled at some point. So when you start using your retracement lines or your extensions, and you know where those gaps are, it just increases that probability that if you're moving in that direction, chances are it's going to get hit. Now, that's obviously not a certainty. On any particular move, it doesn't necessarily mean if there's a gap out there, it's going to get hit. It depends on how the market is trending. But at least when you know those gaps exist, you can make a good, solid decision about what you're going to do. Let me give you an example of why. Now, we mentioned here that there's a fairly significant retracement between these two pivot points. Let's add a few more Fibonacci numbers into the equation, and we're drawing this manually just for the sake of ease here. So this high winds up hitting right in between the 61.8 and the 76.4 retracement. Now the 76.4 was up here at 1246.65. Now, was there anything to indicate that that line is liable to have been hit? Well, the answer once again is yes. There existed a gap at 1246.50. You see it right in that solid yellow line. It originated way, 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 way back here. On 12/12 at 3:05 a.m. So as the market was rallying back up here on the following day, that line took on significance. High probability that was going to get hit because the gap line was right in that same neighborhood. However, it didn't. It was not hit. The market turned and began to go back down. So you can't, it would be imprudent to make a decision to trade on the basis of gaps and retracements alone. You need to have the trend working in your favor. You could have anticipated taking a profit at 46.50. That would have made sense, but as you see here, the market did not continue up at that time. It eventually did, and it was eventually filled. But not at that particular time. So you have to watch the trend. Okay? Let's look at another example. So the market has moved up now, and now we're concerned, it seems to be moving back down. Where's it going to go? So let's just quickly redraw another retracement from here back down to here. How far down is this going to go? Is there any way to know? Is there any gap data that we have to help us out? Under the circumstances, there just so happens to be a gap formed down here at 12:23. It formed on the date of 12/12 at 14:24 hours Central Time. So here's this gap line, 12:23. There's the market. 0% line is at 12:20. Okay, there's nothing between 12:23, between the 23.6% line and 0. There's no Fibonacci number really. And we have a gap down at 12:23, which is sandwiched in between. So logically, if we break much below that first the 23.6% line, chances are it's going back to 0 and maybe even further. So knowing that in advance now becomes a useful tool as the market begins to move down. So capturing a short trade anywhere in this neighborhood with the trend and holding it can result in some very significant profits. So using the gap in conjunction with the retracements can be a very, very effective tool. Let's look at just one more example. Now from the high back here at around 1246, the market continued to drop over a series of a couple of days. It finally hit a bottom in the pre-hour activity on 1214 and began to retrace. Now you can see where our Fibonacci retracements are approximately. Is there any gap data there to help us? Well, as it turns out, there's quite a bit. We look at our gap data and we find that on this particular day, there exists a high gap at 1218.75 and another one at 1225. Now, where do they compare with the Fibonacci retracements? The 1218 is fairly close to the 50% line, and the 1225 up towards the 61.8. So now you have a couple of targets. If you're able to continue to trade this market and you look for opportunities to get into that move, for example, right in here somewhere, you know that there's a gap up at around 1218. You've got that 1221 target there. It doesn't quite make it, comes back down. We're now in the normal session, and all day long it just moves between the 23 and the 38% line and really goes no further. But on the next day, in the after hours market, and then ultimately after the open, we see the market finally does take off. And right up there at 1225, right where our gap occurs, we see the market ricochet. Right there at 1225. And there you have it. Right around 9:20 that morning, the gap was filled. The market went no higher, at least not on that day. Gap fills have been shown to have some predictive value from the standpoint of a pivot. It doesn't always happen, but it happens frequently enough that you need to watch out. So even though there was a fib line above that, that gap was hit exactly, and the market went no further. Now, don't ask me why. I don't know. I have no idea why that works that way. I just know that it does. Very interesting, is it not? So, there's a lot to be gained by using gap information in conjunction with your retracement lines and using them as targets, possibly as entries, but most certainly as targets. Using that can significantly improve your trading results. And that concludes our video on the use of our automated Fibonacci retracements. Look for another video on our extension lines.